Excellent. Okay, hi, my name is Richard Perry. I'm the Chief Market Analyst at Handtech Markets. This webinar that I'm going to be talking about today is just basically sort of pulling together a few sort of thoughts about the markets generally at the moment and look ahead to next week, which I think is going to be a really important week. We need to sort of just look at the fact that I'm going to be talking about just the key drivers, as in sort of things that are going to be really moving forex markets. Within that, I sort of want to do a bit of a discussion, really. I'm not going to sort of stick too strictly to a predefined theme, but I want to just sort of, if possible, open it out actually to see if what people think and what people are thinking about. So what I'm going to do is sort of spend the first half talking about these factors next week, and then sort of move on to sort of doing more of a technical analysis of the markets. So that is what I'm going to be doing. Okay, so let's go. Right, okay, so here we go. Front slide, look at that. There we go. Actually works for a change. Right. So first of all, a bit of a disclaimer, really. I'm going to be talking about live market information and my views. So subsequently, you need to have read and understood this disclaimer. I'm not going to read that out to you because it's very long and quite boring, quite dull, but it is here at the front of the presentation, and also I'm going to show it again at the end as well. Right, just the agenda. Basically, just looking at really covering what the implications were from the Fed meeting, really, and how that has had an impact on markets. And sort of looking ahead to next week, we've got a massive batch of data. First week of the month is always really key, really important data you get in the first week of the month. You get all the PMIs, which I think is are very important for sort of forward-looking bits of data. They're the piece of data really that people are increasingly looking at, and I think that's very important to look out for, certainly on Monday. Then we've got a couple of central banks continuing the central bank theme. Actually, last week or so we've had loads of central banks reporting. ECB, you got a rate cut from the PBOC. You had obviously the Fed on Wednesday, and today we've also had the Bank of Japan as well. So lots going on from central banks. And now next week we've got the RBA, the Reserve Bank of Australia, and also the Bank of England as well. And then we're going to finish off with the Fed on Friday. Sorry, with the non-farm payrolls on Friday. Non-farm payrolls, following on from that Fed statement, I think non-farm payrolls are enormously important now, even more so than normal. And I suppose you probably see that a lot of people say that pretty much every time at the moment, but still, that's what I'm looking at anyway. So within that, anyone who's sort of looking at different factors, we can discuss it certainly. So just give me a shout on the chat box, and we can go from there. So, actually, why don't we just have a quick look at the economic economic calendar from FX Street from Sunday. Big thing on Sunday actually is strangely reported on Sunday is the PMI from China. Now that is important because we've got China, which has, if I can show you the table. Get it going. China official PMI has dropped below 50, and that is important because that would suggest a continued slowdown in China. So what we're looking out for in this China PMI is a move back above 50, and I think that is it's not. I don't think it's forecast, or is it forecast? Where's my data? Where's my data? Yes, it is actually forecast to come back to 50, pretty much bang on. So that will be interesting to see if that happens. So that would be a second month in a row of picking up on the Chinese official data, and that would see the markets open on Monday with a bit of a spring in their step. I think if China is signs of, I say bottoming, but signs of improvement really in the Chinese data. If that happens, then you're going to see some risk appetite, I think, picking up on Monday. Then you've got the Cajun manufacturing, which is the unofficial data. That is out early Monday morning, I think 1:45. Forecast to also slightly tick higher, but the Cajun data is incredibly weak at the moment, and that needs to improve. You need to see that picking up. I think, on that Monday morning. So if you do see that improvement, I think you could easily see some nice pickups in these markets. And certainly in risk appetite, you're looking out for the likes of the Aussie, certainly the likes of dollar yen probably rallying hard as well. So things like that you need to be looking out for. Gauges of market sentiment. The Aussie is very closely tied to China in terms of its movement. So you'd see that. Also interesting to watch gold, I think, on that Monday morning. So this is the... I've actually sort of skipped ahead of myself here. Right, fine. Okay. Well, before we get to Monday, let's just talk about the Fed meeting this week, which we had. Now, basically, the Fed statement really sort of changed the game a little bit again. Fed's been sort of flip-flopping around. I mean, it had that September statement, which sort of started to allude to international developments being a big impact on the market, and the reason why the Fed wasn't going to hike rates. Now, they removed that section of the statement. And also, they explicitly mentioned the next meeting as when they were going to be discussing a rate hike. So that means December is definitely back on the table. If you look at the chances of a Fed rate hike in December, basically 50% now, pretty much sort of 50-50. So the market is finally balanced in terms of its expectations of a rate hike in December now. That was before the Fed meeting on Wednesday. This number, Fed Funds Futures, which is compiled by a CME Group, FedWatch, that was actually saying 37%. Then in the wake of the data, that has climbed dramatically, and you can see the reason behind that. It's this Fed 2-year. One of the factors, or one of the gauges of the sort of the market expectations of a rate hike is the the US 2-year Treasury yield, and that's sharply moved higher. Look at where it got to in September, though. September, it got strongly higher, above 80 basis points. Now it's currently around 72, 73 basis points. So there is still movement to go in this market, I think. And if that continues to go, then that would suggest dollar strength, I think. What you have seen in the last few days is really last couple of days is the dollar starting to correct a little bit of that initial strength. But I think ultimately it's going to come back into, this is the trade weighted dollar, I think it's going to come back into sort of a bit of a sort of pivot area around this sort of 96, 97 area, sort of 96.4 to 96.7 area, which is sort of not too far away from where it's got to now. And I'll show you a bit later that that sort of equates to, I reckon, the 111, 110.50 to 111 pivot band on euro dollar. So very important move that we've seen there. So we've got the Fed meeting, which has sort of turned the corner, I think, again on rate expectations. So what you're going to see now, I think, is volatility. And you're going to see volatility around all the key US data points because the Fed sort of was talking about how the fact that it's going to now be looking, well, it's been data dependent for ages anyway, but I think it's going to be looking out for the key data points, certainly around inflation, unemployment, and growth. And what ultimately we've seen since that Fed meeting on Wednesday, we've seen the growth data disappoint a little bit. You've also seen the the inflation PCE not picking up. Core PCE 1.3% on that data. Now, the core PCE is the Fed's preferred measure of inflation, and it hasn't been picking up. And what you need to see, I think, ultimately is the core PCE picking up. Again, today, that's just come out and not picked up. So, again, there's no real signs of inflation. Now the Fed's going to be looking towards non-farm payrolls, and I will talk about that in a bit. But, yeah, non-farm payrolls, I think, becomes incredibly key now. However, what you have got, I think, ultimately, with that Fed move, is the dollar going to be strengthening near term. Question is for how long, but still, I think it's going to be strengthening. I think it's going to be I think it's still going to be range bound, but I think it will be strengthening because the market around these sort of expectations of the December rate hike, I think is going to sort of start to see the dollar strengthen. Any sort of data that comes out positively for the US will be, I think, dollar strong and continue to push that higher, that dollar higher. So this is all going to have an impact across gold, especially there was a massive turnaround on gold yesterday and the day before, lower. Euro dollar also had a strong move. The Aussie, I think, could come under pressure as well for other reasons, not only due to the fact that you've got the Fed sort of pushing towards possible hike, but also the RBA, which may well be set to cut rates next week as well, and I'll talk about that in a bit as well. Cable, I think, is less volatile because I still think that cable is sort of on a bit of a similar path to the Fed in terms of the UK Bank of England. Similar sort of interest rate differentials there. It's just going to be as to when the Fed moves. I think the Bank of England will probably move one, maybe two meetings later. So, yeah, it'll be interesting to see that. As I said, yeah, watch out for the US 2-year Treasury yield and also those Fed funds futures that I was talking about just now. So, key data points. As I said, manufacturing PMIs. That starting off with those, the China data, which is on Monday, and then we go into the Eurozone data. And also UK data. And I think the PMIs could well set this tone for risk appetite next week. As I said, the China data is, I think, key to this. So you're watching your Aussie and your Kiwi. Those are two commodity-based currencies, and certainly the Aussie is very finely tuned towards China. So watch out for those two. If you see an improvement in sentiment in China, you should theoretically, I suppose, see an improvement in sentiment towards the Aussie and the Kiwi. You could also see the US dollar pick up. US dollar yen is, I think, the market's gauge of safe haven. So any improvement in China should be a move away from safe haven trades, and subsequently that should help dollar yen to pick up. So we've also got the ISM data, manufacturing data, the ISM PMI, which is also on Monday. So we're looking out for, first of all, the Eurozone data. That has been fairly settled, actually, in the last few months. Quite nicely settled around that sort of 52 mark. So you're looking out for that, presumably just to sort of hold flat around that sort of level, maybe even improve. But it'll be interesting to see how that one goes. And then you got the UK data, which is certainly going to have an impact on sterling. Sterling will be interested in the fact that I think the UK manufacturing PMI is actually forecast to pick up slightly, I think, to 52.3. Let me just check that. Sorry, yeah, I think it is actually forecast to just check that. UK PMI, yeah, 51.3. So actually, it's meant to just slightly deteriorate. So that's not going to be all that helpful for sterling. But the interesting thing I think is going to come with the ISM data. This hit 50.2 last month. That is the lowest since 2013, mid-2013, when it hit 50.1. Now, I've been talking about for a while the sort of regional Fed surveys. The regional Fed surveys, when you see them falling below zero and into negative territory, that suggests a slowing of growth. Now, New York, Richmond, Dallas, Kansas City, and Philly Fed have all gone below neutral, below zero. Now, that would suggest that the outlook for the US economy is not great, because it would suggest all these key economic regions are sort of seeing below trend growth. And that would suggest a slowdown in the US. And potentially that would, as I said, in terms of the ISM data, that could see a fall back below 50 now. Now, the ISM data is actually forecast to fall at 49.6, so that certainly would not help the Fed in its sort of track towards tightening. So very interesting bit of data that at 3 o'clock on Monday for the US. So, moving on, we've got central banks and two big central banks, two major central banks reporting this week. You got the RBA on early Tuesday morning, RBA, and also the Bank of England on Thursday. Now, the RBA has got a decision to make. Now, it has cut rates already twice this year in February and May. Now, it has been interesting actually, because let me just show you the movements of the Aussie on those decisions. Okay, so we have here, I think it was the 2nd of February, the rate cut for the Aussie. Look at that fall in front of that last rate cut. Sharp decline as the market sort of started to move towards the pricing in a rate cut. Then you got the rate cut, and the market basically went sideways for a good month or so before just dipping again. Look at again in May. I think it was May the 5th, which is, if my eyes would do me justice, there. Look at that. The Aussie actually rallied on the day of a rate cut. Why should that be? Well, it had a bit of a dip in front of the move, but it's very interesting that you see these sort of moves in front of the rate cut, and then as that action happens, the market actually rallies. And what we've got at the moment is the Aussie in decline. It's been in decline for a while. Actually broke down on Wednesday, I think it was this week, on the back of weaker than expected inflation data, falling to 1.5%. And that sort of gave a technical breakdown. Actually gives us a downside target of 70.20 on the Aussie. So there is still further downside potential in this move, hitting a low of 70.60 or thereabouts. So on Monday, I mean, you've had this little bit of a rebound today, and that actually came on the back of on better than expected sort of PPI data, producer prices index data, factory gate inflation. So you had a better than expected move there, but still, fundamentally, you've got the 4 big banks in Australia which have actually been putting up their loan rates, their sort of mortgage rates. Basically, that's as a sort of way to pass on costs to the customer of the requirements that have been engaged in something called the Murray Report, which has basically meant that it's sort of like a macro-prudential move whereby the banks need to have a bigger capital buffer in their balance sheet. So to prevent sort of losing out on that, the banks have sort of passed on that in terms of the cost of that into its customers with an interest rate rise on its mortgages and loans. So the RBA is now left with a decision. If it doesn't cut rates, then that's actually monetary tightening, effectively, because obviously the banks have increased their interest rates. So what does it do now? It may well have to cut interest rates. And not only that, you're sort of still dealing with the China slowdown. You're still dealing with increasing unemployment in Australia. So there's a lot going on that would sort of argue towards maybe a rate cut. Maybe this month, perhaps next month. But obviously the market has fallen away in front of this meeting. And there is the prospect of a rate cut. But as I said, be careful, because previous rate cuts have come with the Aussie, which has sort of fallen before the rate cut and then actually risen in the wake of it. So we've got that, the RBA, possibly with a rate cut. So obviously that's going to have a big impact on the Aussie. So yeah, possibly sell on rumour, buy on fact. Now, the Bank of England this week is on Thursday, or next week, sorry, on Thursday. 12 o'clock is the announcement. And also it's, I'd imagine they'll call it another Super Thursday, because it's the time when they've got the Bank of England meeting minutes and also the quarterly inflation report all released at the same time. So you get all the big sort of views out from the Bank of England all at once. Now, the important factor that we need to look out for on the Bank of England quarterly inflation report are the growth and inflation targets for the coming years. Now, they slightly revised them lower in the last report. Certainly, the GDP data was revised slightly lower. And also inflation was expectations were revised slightly lower. So watch out for inflation expectations again potentially being revised. If that is seen to be the case, because obviously the UK has sort of dipped back into deflation once again since that quarterly inflation report. So the fact is that deflation or or negative inflation now, sort of negative 0.1%, is the outcome in the UK. So it needs to see sort of improvement in that. So you might well find that the Bank of England will once again sort of cut its inflation targets for the coming years. So that would be sterling negative. So again, that would have an impact on sterling. So let's just have a look. Oh, that's the hourly chart. Let's look at daily chart. So sterling, which has sort of been very choppy, isn't it, really? And again, today it's sort of started to rise again. So it's got sort of 2 or 3 days until that Bank of England report. So you might see a little bit of a rally going on, but still generally, if the Bank of England did cut its inflation target, then you would likely see, or you would see, a decline on that sterling price. So just watch out for that. So yeah, currently cable in a choppy range, but again, I think the data will be driving cable for both US and UK side. So that I think is going to be the case in the coming weeks anyway, and that is likely to drive expectations of possible rate hike as well out of the UK. Now, in terms of the voting structure on the Bank of England, there's only been one dissenting voice, which has been Ian McCafferty. He has been voting for a rate hike recently and continues to sort of be quite vociferous in terms of his sort of arguments for a hike of interest rates. But there haven't yet officially been any sort of people joining him. But we could well start to see Martin Wheel and perhaps even Kristen Forbes as well, possibly changing camp, possibly sort of moving towards sort of potential arguments for a hike. They have been, or certainly Kristen Forbes has been sort of more hawkish in her rhetoric recently, and this could well be seen. So watch out for the minutes as well. Watch out for the voting makeup. So the number of people voting for a rate hike is not going to happen, I don't think, this month, but it's sort of still potentially sort of the start. You could start to see a couple or one, maybe two more voting members joining Ian McCafferty on the hawkish side. And finally, next week, we've got that massive US employment situation report. Now, that is the sort of collective term for the payrolls report, where you got all this employment data coming through on Friday. And now, non-farm payrolls have been very interesting in recent months because they have been, let me just show you the payrolls. That's RBA, non-farm payrolls. There you go. Right, non-farm payrolls have been sort of disappointing, really. They've actually, last couple of months, missed expectations. This is the Reuters expectations. They've missed expectations, the blue line, on the data. And the dollar has suffered on the back of that. So what you've had is the payrolls report falling, or the headline payrolls falling below 200,000, and that's interesting. But the non-farm payrolls report is not the only factor in this employment situation, because non-farm payrolls is just the headline that everyone sort of points towards. It's not the only factor in this report. You've got to look out for other factors as well. Other factors including average hourly earnings. Average hourly earnings seem to be sort of a lead indicator towards inflation. Now, average hourly earnings have been very sort of stubborn in their sort of refusal to pick up in the States. Now, there are a number of factors behind that, and I'll just quickly flip forward towards the participation rate, because the participation rate has been falling quite sharply in the States. So the people or the labour force, the size of the labour force has been dropping. And I think that's driven to a certain extent the unemployment rate lower, because the unemployment rate is now at 5.1%. The Fed continue to sort of drag its heels in terms of dropping what it sees as full employment in the States. 4.9 I think is the current level, but it could be even as low as 4.8, 4.7 in the States. And that would suggest that there is still room for maneuver in the unemployment rate before we start to see inflation picking up. And I think that that is the reason why we're seeing the participation rate falling, or certainly one of the reasons why. And I think that another reason why we're seeing the lack of growth in wages. Now, this month, we're expected to see wages at plus 0.3% on the month. And that would actually equate to 2.3% growth on annual across the year. Now, 2.3% is basically sort of the level it was at in May this year, and also level it was at in December 2012. But if it sort of starts to pick up, if it sort of, say for example, grew by 0.4%, which would see a pick up to 2.4%, now that would be sort of starting to get a bit of traction. So it'll be very interesting to see. Last month we had an expectation of 0.2. It actually came in at 0.0. So the average hourly earnings are still, I think, a big factor on whether the Fed ultimately will be moving on rates in December. I think that the average hourly earnings need to pick up, because you're not getting a pickup in the PCE, and average hourly earnings could be the main driver, I think, of a pickup in, or the expectations of a Fed rate hike in December. So that is, broadly speaking, the sort of analysis of what's going on next week. And having done that, let's just look at this slide here. This is the employment situation. So basically, if payrolls push above 200,000 after 2 disappointing months, I think that would be a strong indication. Current expectations is 180,000. That tends to sort of move around in the coming days, but 180,000 is the expectations at the moment. Also, the expectations, as I said, are average hourly earnings picking up, and the participation rate. If you see a strong payrolls report, if that participation rate can steady, again, the participation rate last month dropped to 62.4, I think it was, which was below expectations. So that is another factor to watch for, participation rate, if that sort of starts to steady or pick up. Now, the impact of this on markets. A strong payrolls report would be hawkish for the FOMC and drive December rate hike expectations. Now, the big follow-on factor from that would be a stronger dollar. And dollar strength is obviously the big sort of takeaway from the payrolls report. Lots of volatility, loads and loads of volatility around the payrolls report, always. Now, a strong dollar would also generate probably gold weakness. The gold price has been driven by the payrolls report quite strongly in recent months, and I think if the payrolls report came out strongly, then that would drive gold weakness, and we've already seen gold dropping quite sharply on the recent FOMC statement, which, as I said, put the December rate hike back on the table, and I think that was key to that move. So a payrolls report that's strong will be gold weak. Now, in terms of equity markets, difficult to say really, because the equity markets have been fairly sort of, well, obviously they had a massive run higher in October, but they had a fairly sort of volatile move on Wednesday around this Fed meeting, because I think the market is now getting to the stage at which it needs to see a rate hike. And there's actually chatter that would suggest that talk that would suggest that sort of there needs to be normalization of monetary policy for companies to start sort of starting to sort of move on, really, because if you look at the fact that forever low monetary policy around sort of almost zero interest rates, you've got Schumpeter's law of creative destruction doesn't happen, because you see all these sort of zombie organizations that are continuing to limp on. They don't get sort of closed down because they can continue to pay at zero interest rates, and it ultimately doesn't help the economy to regenerate itself, to sort of effectively and efficiently sort of reallocate resources. So that is the argument, I think, behind why the market needs the Fed to start normalizing monetary policy. And it will be interesting to see the impact on equity markets if that were to be the case, if the Fed does decide to hike rates. Right. So that's the end. So that's not at the end. But what I'm going to do now is we're going to look at some equity some key markets. Right. So let's have a look at some technicals on the major markets, the major forex markets. This is Eurodollar, and what you can see in Eurodollar is this. This is Eurodollar over the past year or so, 8-10 months. And what we have seen is Eurodollar basically moving in this sort of sideways trading range. If I zoom in there, you can get a gauge of this trading range. So between 108.10 up towards 1465 generally has been the limit of that. There was a slight spike higher, but we're back inside that now, and it's sort of moving around that. And within that, there is this trading pivot band. Look how often 110.50 to 111 has provided the basis of support and resistance. So 50 pips, I'm saying, of pivot band in this market, around 110.50 to 111. And that is, so let me just, hold on one sec. So yeah, around 110.50 to 111 has been where we've seen the Eurodollar. And it's actually rallied in the last couple of days quite strongly, actually, back towards 110.50. So it's sort of unwinding some of that Fed selling pressure. Fed actually, sort of just prior to the Fed meeting, Eurodollar turned lower from 110.95. Basically, again, that 111 pivot band providing a basis of resistance. So that's what you're looking out for. You're looking out for this move unwinding this momentum. So you're looking out for the RSI back towards 50, giving you a selling opportunity, I think, because what you've got now is more corrective momentum. It had been positive above when you were above that pivot line, continuing to come back towards 50 and bouncing, and now you're below it. I think you're sort of bouncing towards the sort of 44 to sort of 50 level, and I think that could well give us a chance to sell. You've had this little mini rebound. It'll be interesting to see now if that chance to sell. This is the hourly chart, and you've got that rebound into this sort of band of resistance now, arguably 109.87 up towards 111, but very interesting seeing this move. Now, in terms of the hourly RSI, in the last few minutes or hours, you've just seen the RSI on the hourly chart come back towards 70 again. That's the level it's been at a couple of times prior to falling over in the last few days. So that's interesting in itself as well. So is this now this opportunity back into this resistance band? Are we now looking out for an opportunity to sell Eurodollar? So yes, I think you're looking out for the next sell signal on Eurodollar. Okay, let's have a look at cable. What we have seen in cable is an interesting turnaround, actually, and you're actually now sort of forming the second day in a row where we're going to see a strong close on cable. So that is a very positive move. Look at these stochastics indicators. They have turned up. In the last few months, the turning up of the stochastics have been a really good trigger, actually. Bull crossover, you could argue, but normally you would be looking out for the sort of cross to come underneath 20. But interesting that the one we saw in August or early August gave us a crossover below, around about the 30-40 mark. And that was actually a pretty good signal. Actually signaled a couple of weeks of rally. So what we've seen is the stochastics turning around again, cable turning around. Now, in terms of what we're looking out for on the hourly chart, well, that's a very interesting move, actually, because we've seen now a bit of a near-term turnaround. I said in my morning report this morning, or my videos, that you've seen in the last sort of couple of weeks, really, cable sort of failing around that 70 mark. And it's interesting that it's sort of formed support of 30. So you're still sort of neutral. If you start to see the hourly momentum moving above 70 and sort of holding above there, that would suggest strong momentum. Look at this run higher that we saw on the 14th, where the RSI went strongly above 70. You had a really strong run higher. ran a long way higher on that day. So you could see that again if that were to be the case. Now, the big overhead resistance comes in around 54.15, but it needs to have a look at this initial resistance, which was this candle here at 53.80. If you can see it break above, see obviously that's going to open that 54.15 key resistance mark. Look at that level. It was a trading range. And then it broke down on the support, and that level, old support, becomes new resistance. So that 54.15 is your new resistance level. So we need to look out for that. That's your key level on the upside. So we're looking out for improving momentum. If you see the RSI above 70 and going, in fact, it is having a good go now. So probably you'd be sort of looking out for sort of pushing on with this. 53.80 is your sort of key level. It's coming up to that, towards that level now. So it certainly seems as though cable's had a near-term turnaround. As I said, there's a lot going on next week, which is going to drive cable. You've got PMIs from both UK and US on Monday. You've got the Bank of England Thursday, and obviously payrolls on Friday. So lots of volatility you could well see next week. And I think we need to continue to look at this one, certainly for this resistance at 53.80, but this also the resistance, the big level at 54.15. So let's have a look at dollar yen. What's happened to dollar yen? Really interesting that we're seeing that dollar weakness today, that dollar correction, and we're seeing dollar yen falling away. It is pretty much range bound. Last few days, it's not really gone anywhere, is it? Very volatile also within that range. You've got obviously the Fed dollar strength on Wednesday. That's almost entirely unwound now. Interesting. And you've seen these momentum indicators I mean, they're sort of more positive. You'd say trading above I'll show you this pivot level on dollar yen. Here we go. Just zooming out across the last few weeks. This pivot range, this trading range on dollar yen, and you've got within that range a pivot level. 119.60 seems to time and time again be a basis of support, and then became resistance. Became resistance on the 16th, and then became supportive again 22nd. So you're looking out for that level being your key pivot. So whilst you're trading above that on dollar yen, you're still relatively positive, I think, and you're also holding on to these supports at 120.15 sort of area. You're holding on to those levels, and until you start to see, I think, the hourly RSI breaking down below 30 consistently, I think you're going to see fairly well supported on this dollar yen chart. You got that pivot at 1960, but also this support sort of 2014, 2015 area. So that's still holding. So I'm still relatively sort of bordering on positive within this trading band. Momentum indicators remaining relatively positive, actually. Stochastics are still okay. RSI has dipped a bit today, back to 50, but still, again, 50 is sort of, you're still relatively positive if you're sort of trading above key supports. So it's not too bad yet on this dollar yen chart, but it'll be interesting to see how it goes. Right, let's have a look at the Aussie. Aussie, on a technical basis, as I said, has broken down below the 72 big figure mark. 72 big figure has been a sort of a pivot level on this chart. Old support, new resistance, a couple of spikes through it, but still ultimately didn't close above that level. Then became supportive, having closed above it, and now it's sort of turning lower again. So you'd say becoming your sort of basis of resistance, 72 figure, but also that's arguably completed a small top pattern, which you can see if you zoom out on this hourly chart. You can see this sort of double top, I suppose, pattern, and that actually gives you a downside target on that break below 71.95. That gives you sort of 70.20 as your downside target, which pretty much brings you all the way back down to sort of this level here, which is again sort of support band, sort of 70. Sort of 70-20, 70-40 area. So there is still sort of downside, I think, in this Aussie dollar move. I think rallies are going to be seen as a chance to sell. You've seen the RSI and the hourly chart go below 30. And again, you've sort of seen this rally, this recovery rally that we've seen in the last sort of day or so. Rolling over, interestingly, at 60 on the hourly RSI. Look at that, those MACD lines sort of unwinding back towards neutral. Again, will that now give you a chance to sell? Sort of that unwinding element in this chart where the oversold momentum has been sort of unwound, but it'll be very interesting to see how this one goes. But I still think sort of rallies are going to be seen as a chance to sell in front of this RBA meeting, but there could be a rate cut on the way, and I think that the Aussie could come under pressure in front of that meeting. So that will be an interesting one to watch. Right. So let's look at the Kiwi. Right. Get rid of that crosshair. That's the hourly chart. That's the daily. Kiwi's been interesting actually because it's sort of been in this little, shall we say, sort of almost downtrend channel really in the last sort of couple of weeks, 3 weeks. Drifting lower, and the momentum indicators certainly reflect that. You've got this crossover on the MACD lines. You've also got the declining element in the stochastics as well, falling away. RSI confirms what actually sort of RSI is at 1, 2, 3, 4 week low. Actually would suggest that you're going to come back and test that 66.14 mark. There has been a bit of a recovery today, and that's been apparently on the back of sort of improved expectations of milk prices, which milk prices have a big impact on inflation in New Zealand, and that has sort of seen that the Kiwi tick higher, a bit stronger. And also you've had the dollar weakness as well. But still, I think you're in this sort of corrective phase. Nonetheless, I think, and that's what the momentum indicators are telling me. You're still in this sort of corrective phase, and I wouldn't be surprised to see sort of a bit of maybe a retest of these lows. And if that were to be seen, 66.15 area, if that were to be seen, I've got that 66.14 support in there. Pretty much 66.18 was the reaction low that we saw on Wednesday, following on from the Fed. You've seen this sort of move, and I think if it starts to sort of lose momentum on the upside, look at that. You've already seen that the MACD lines cross over. MACD lines crossing over. It tends to be a pretty good signal on this chart, doesn't it? MACD lines giving us a crossover. Work there. A very good one there as well. And we've just had another crossover near-term sell signal. Stochastics also now having given a sell signal and falling away. RSI failing again at that 70 point. So is this the limit of that rally? You'd say that you'd be looking out for 68.13 being that reaction high on Tuesday. Yeah, Tuesday. So that's your sort of key resistance, I think, near term. But it's interesting that we've seen all these momentum indicators starting to roll over, which could well sort of question how long this rally is going to go on for. So this little rally that we've got in the Kiwi may start to come under a bit of selling pressure once again. So that could well be seen. So let's have a look at the CAD. Canadian dollar. Canadian Kiwi, that's not right, is it? Why does it do that? CAD equals, please work. Yes, right. Now, we've had this strong rally on the dollar, and it's just started to roll over a bit. Look at those stochastics down there. Very interesting. Crossover sell signal. Not yet confirmed. Confirmation on the stochastic sell signals comes on a break below 80. So you haven't had a confirmation of that sell signal yet, but the pressure is sort of just drifting down. This is the hourly chart. we've seen these sequence of higher lows and higher highs. You've just seen a bit of, arguably a break of that sequence, but certainly the key near-term support comes that sort of 30.37, $1 Canadian dollar. That is $1 30.37. That is obviously your key near-term support, because that is your sort of level at which you would start to see the confirmation of the breakdown of that uptrend. Now look at these momentum indicators throughout that trend higher. You've got the MACD lines, which constantly give you a near-term correction signal, but then you sort of see your trend reforming around that neutral point. We've now gone below that, and we're now struggling to get back above the neutral line on the MACD lines. So that's a correct line. And also, it's interesting that we've seen this the RSI, which is not obviously. You've seen lower highs, or the prospect of lower highs starting to form, certainly with this one here. 32.28, that one there, clearly yesterday's high, potentially another lower high. So interesting that we've seen this move, and you could well see some test of that 30.86 level on the Canadian loonie. So. Sorry, I was just looking at FX Boyke. Hold on one sec. Your indicators reflect prices, so are they necessary? Right, good question. Yeah, I mean, it sort of opens up a big discussion, doesn't it, about what indicators to use, whether, I mean, so for example, moving averages, why use a moving average when it's a sort of lagging indicator? I would say I want the most amount of information at my fingertips available, and for that reason I like to use momentum indicators and price indicators. I like to use these momentum indicators to give me confirmation of price moves. At the moment on this CAD chart, I think what you're seeing is pretty much confirmation of what looks like the end of this rally. The end of this rally here. Now that doesn't necessarily mean we're going to be pulling lower. It just, I think, would suggest to me that we're now sort of struggling to push forward on this, and near term you're sort of turning more either more neutral or potentially for a correction. Now we haven't seen a test of that support yet, 30.86. I think once that sorry, FX working, I mean the three at the bottom. Yes, the RSI, the MACD lines and the stochastics, all momentum indicators. And as I said, I use them as confirmation tools for my price indicators. Are they necessary? Again, I mean, in technical analysis is whatever works for you, because there's a lot of indicators you can use. A lot of people like to use momentum indicators. I like to use these three because I think that they give me more information than I get just from purely looking at price action. Yes, obviously the price is theoretically everything as per Dow theory, but still I think that I want to have more confirmation of that with the momentum indicators that I use. So which is why I do sort of like to look at them a lot and refer to them a lot as well, because they give me sort of confirmation. That's absolutely fine. Thank you very much. So yeah, so the CAD is sort of broken this uptrend. I say uptrend, I haven't even drawn it in. Let's draw it in. It's broken that uptrend, isn't it? So now when you break an uptrend, it doesn't necessarily mean you're going to be falling. It means that you could enter into a sideways trading period, which could quite easily be what we're seeing. But still, I think the fact is that we've seen these momentum indicators starting to roll over. So that's what we're seeing on CAD. Now, running out of time, so I'm going to say gold, because gold, oh wow. I can't believe it. I was on the brink. I was so close to turning positive on gold. I even put, I think, a tweet up about it because it was breaking out above 1180 on Wednesday, just before that Fed meeting. Fed comes out, hawkish statement, big dollar strength, and you've got gold price, which has fallen and fallen hard. That hard fall is now continuing. You see these momentum indicators, which are very weak, very strong momentum to the downside. MACD lines crossing over, RSI falling away. You've now got the prospect of what I see as the turning back of negativity. If you see the fall below 1140, 1140 being an old support, old support. I mean, to be honest, between 1140 and 1170, I've been sort of, I thought I was going to get another buy signal within that range, but below 1140, I've got to turn negative, unfortunately. And what we've seen is this sharp 3 candles downwards negative move, sharp move to the downside. Now, if you see a move below that low there, 1136.50, I think that's pretty much confirmation of that sort of turn lower. You could argue, and I have got it in on my morning report, that there is a slight uptrend there. I don't necessarily think that's a great uptrend, but you could again draw in sort of a very shallow, not the best way of drawing it, very shallow uptrend channel. I'm not sure about that, because if you see, for example, the RSI falling below that 40 mark, that would turn, I think, again, a confirmation of negative momentum, and that's becoming increasingly negative, I think, in that stage. And I think that at that point, you're probably then going to come back and test that 1104 level. So if you break below 1136.50, which was this reaction low here, I think you've got, I'm going to turn negative, and certainly for a move back towards probably that range support, which currently comes in at 1117 sort of area. So it's a really quite a significant downside move that we've seen in gold in the past certainly the past few days. But I thought that what this was going to turn out to be was a nice little sort of rounding buying opportunity, because you saw loads of these tight bodied candles, which suggests uncertainty. Then you saw a positive candle. I was on the brink of turning positive, but again, since that Fed, it's been absolutely scuppered. And I'm going to have to change, certainly will change my outlook if you see a move below 1136. I'm now neutral on gold, because I'm back below the 144-day moving average. Pretty much momentum indicators are not in bullish configuration anymore. You've got that stochastics falling away sharply. So pretty much across the board, you're fairly neutral, if not almost turning negative on gold. So that is certainly the outlook there. Now let's have a look at silver quickly, because silver was on the brink of 1550. Yeah, it's still holding on 1550. That is your equivalent, arguably, support. It's not fallen away that sharply, is it? Look, compare that to gold. Yes, you've got these stochastics which are quite negative, but the RSI is still relatively positive. Hasn't broken below that 1550 mark. 1550 on silver is a historic level, really important historic support, pivot level. Does it go back further than that? No, it doesn't. Sorry, I've gone far too far, being silly. Right, so yeah, 1550, I've been talking about this for ages. It's been a really key level, provided the resistance again here, and subsequently supportive. So if we started to trade confirmation below 1550, then I think we're in trouble in terms of a correction. You would also start to talk about this being a top pattern. You'd sort of measure the high, 1619, so that's what, 70 ticks. Downside from 1550, 70 ticks is 1480. 1480 is sort of not a million miles away from sort of dropping back into this sort of trading band here. So it could well see a corrective element. 1550 is a big support. So if you start to see that closing below 1550, I think you're sort of into the realms of a quite a bit of downside again on silver. But interesting that silver and gold, in those two charts, gold is falling more rapidly than silver, is under more pressure than silver. So something that we need to look out for there. But right, okay, well, I think that's sort of, let me just look at oil very quickly. I know a lot of you look at oil. Two ways of looking at oil. WTI. This is WTI on oil. Big support. 43.20. Big support. Massive rally off that level. So you zoom in here. Doji candlestick yesterday. That's not great for the rally. You've not got too much of a positive candle either today. But what we have got is this improvement in stochastics, which is a positive. RSI bang on 50. So you're sort of relatively neutral, I think. And unless you see a sort of a move above 47.50, which was this reaction high in mid-October, I don't think you can get really positive about this. I think it's just possibly even unwinding the oversold momentum on that. So that is WTI very quickly. But okay, so oh no, let's go back into that. There's my disclaimer. Oh, no. Crikey. Let's just try that again. Talk about research first, won't we? Right, here we go. Hantech Markets research page. hantechfx.com/market-research. You can sign up to get my research straight into your inbox every day. All good. So you get videos on there on the right-hand side. All my research is on there, so come and check us out. It's hopefully interesting for you. And then, apart from that, you've got my Twitter handle, which is @HantechRich. And in December, we're going to be doing a next webinar series, Mastering the Macros. So you can go to the website, check that out. But that is going to be taking you through a load of key fundamental economic releases and how they impact on the markets. So hopefully that would help you. But we're going to start that series in December. So with that in mind, I wish you good luck in your trading, and we're going to look at the disclaimer for one final time, and I'm going to leave you with that. So until next time, I wish you good luck in your trading, and yes, take care. Thank you.